Good morning, everyone. Welcome to today's live webinar, Rebuilding a 60/40 Portfolio with Smart Alternatives. I'm Hannah, a member of the marketing team at VanEck, and I'll be your host for today. In today's session, our speaker, who I'll introduce shortly, will be challenging the validity of the classical 60% growth assets to 40% defensive asset approach in light of how the investing environment has changed. You'll hear insights into the key considerations and levers that the Future Fund and the team at VanEck see as necessary for crafting robust and more resilient portfolios. Before we do begin, a few reminders. Today's webinar is being recorded, so if you do miss out on any parts, you will be able to access the recording and also the slides later on. A reminder that what is presented today is general in nature and is not personal advice. It's important to consider whether or not a particular fund is appropriate for you and what you're looking for. For details and more information on any of our funds, the place to go to is vaneck.com.au, where you can find the product disclosure statements and the target market determination for each fund. There is some additional important information at the end of the presentation to have a read of. Allow me to provide a brief introduction for those who may be new to VanEck. We are a leading global fund manager, bringing more than 60 years of investment expertise to our clients around the world, currently managing nearly 80 billion US. We've been providing award-winning strategies in Australia since 2013, becoming particularly known for our leadership in smart beta strategies. Now with a lineup of 33 ETFs listed on the ASX, we continue to be dedicated to bringing the best quality investment solutions to clients. We tend to do this by adopting a beyond the usual approach to established investment categories and by offering access to new asset classes or those that are often underrepresented in portfolios. I'm delighted to introduce our expert speaker for today, Julian Moore. Julian is responsible for business development across the broker and financial planning channels in New South Wales and the ACT. Before starting with VanEck, Julian worked within private client advisory at Bell Potter Securities. Welcome, Julian. It's great to have you join us.
Thanks, Hannah, and good morning, everybody.
Over the next 15 to 20 minutes, Julian will be delving into the origins of the 60/40 portfolio, shedding light on the evolving investment landscape and importantly discussing what it means for investors of all types. We want to make sure you as the audience get as much as you can out of today's session. So please, so the second half will be dedicated to Julian answering some of your questions. If any come to mind throughout, please pop them in the Q&A function. With that out of the way, Julian, over to you to get us started.
Fantastic. Thanks, Hannah. So I guess to first step into things and to understand the prevalence of 60/40 portfolios is to understand the history of modern portfolio theory. And it was over 70 years ago in the early 1950s that Harry Markowitz applied mathematics to the analysis of the stock market. And actually, sadly, last week, Harry Markowitz actually passed away at age 95. But in his paper in 1952, in the Journal of Finance, portfolio selection was the first time that analysis considered the impact of risk on portfolios. And it became the origins of what is now called modern portfolio theory. And this led to the development of his theory of portfolio allocation under uncertainty. So according to Markowitz, an investor would or should want to select a portfolio with a combination of stocks which aim to give a maximum expected return for a lower level of volatility. And all the combinations of the portfolios would fall into this circle that you can see on the slide here. And so within Markowitz's paper, he used maths analyzing the returns and volatility of 3 stocks and what combination of these stocks would give the best outcome. So the optimization techniques developed by Markowitz led to what was known as the Markowitz frontier, and that's now later known as the efficient frontier. And so what this analysis showed is that, unsurprisingly, that diversification was actually good, and it implied that the right kind of diversification for the right reason as investors consider risk in determining their own goals. And it was evident to Markowitz, who concluded that we should diversify across industries because different firms that are operating in different industries, especially with industries with different economic characteristics, have lower covariances than firms within their same industry. Now, Markowitz was actually often termed as saying that diversification was the only free lunch in finance. And so what diversification is an investment strategy that lowers your portfolio's risk and helps you to get more stable returns. And it lowers portfolio risk because different asset classes do well at different times. And so if one business or sector fails or performs badly, you're not going to lose all your money. And having a variety of investments with different risks will balance out the overall risk of the portfolio. So on the basis of this, investors should diversify across different asset classes. And for years, this 60-40 portfolio became the staple. And so what is it? Well, back in 1952, there were actually only really two markets that had sufficient data that was readily available for analysis. And this was the US share market and the US government bond market. And so using these, it became apparent that the optimal return for between 10 and 12% risk was an allocation that included 40% in bonds or defensive assets and 60% in shares or growth assets. And so this finding is actually consistent with earlier support for portfolio diversification by Benjamin Graham in his book, The Intelligent Investor, where Graham actually advocated for a portfolio of 50-50 stock bonds as a baseline allocation. And then this could later be shifted as far as 25-75 in either direction based upon market conditions. So the way that Graham approaches asset allocation was that is if the stock or growth component is the variable investors should consider when determining their asset allocation. And this may have been due to the relative dependability of bonds compared to stocks back in 1939 when he wrote the book. At that time, bonds and other defensive assets preserved capital and provided dependable income. And so that approach wouldn't have helped Graham in the last few years, however. So this led to the predicted death of the 60-40 portfolio. And if you fast forward 80 years, bonds, whilst still preserving capital, could no longer be relied upon to provide dependable income in the fallout of the COVID-19 crisis. And so in 2021, yields were at record lows, and a number of financial professionals and institutional investors had suggested investors need to diversify across other asset classes away from bonds. One other global asset manager was also recently quoted as saying that non-traditional asset classes such as infrastructure and property will evolve from optimal to being indispensable over the next 10 to 15 years. So, if 2021 put the 60-40 on life support, 2022 was really the death blow for this allocation. As you can see on this chart that we've got on the screen here, 2022 saw many asset classes that were highly correlated on the way up post-COVID remain highly correlated on the way down. And investors couldn't rely on bonds to cushion the falls of riskier growth assets as they had in past crises. And what you can see on this chart here is that prior to 2022, the worst year for Australian bonds was back in 1994, when the Australian Oz Bond Composite Bond Index fell almost 5% in that year. But last calendar year, it fell almost 10%. So that was a real sell-off in the bond market and provided quite a shock to a lot of investors. But after 2022, we see that this dynamic has seemed to have unwound. However, the market still remains undecided on whether this is unwound enough. But now that bonds are paying income again, we think that the 60-40 portfolio is back, but it's changed. But we do like it quite a bit more, given that rates have started to move up quite a bit. Now, we did outline our thinking on 60-40 earlier in the year in an opinion piece in the AFR, which was written by our Australian CEO, Ariane Neuron. And in this article, we highlight that we never actually thought that the 60-40 was dead, but it was really just more changing in a new investment rate regime, which created a paradigm for such change. And we believe that these changes have occurred in the investment landscape. They have the potential to make diversified portfolios more robust than they've ever been. So now let's look at how institutional investors approach alternatives to diversification. And one example of the newer diversification approaches to portfolio management is the Yale model, which was developed by Yale's then Chief Investment Officer, David Swensen. And so the way in which Swensen considered different exposures and approaches included alternatives when building investment portfolios. And he pioneered the endowment model, which is used by many US universities and institutions today. And what Swensen said is that one of the most important metrics that we look at is the percentage of the portfolio in uncorrelated assets. And that the magic of diversification is that if you've got things that are individually risky, but they're not well correlated to one another, that the overall portfolio risk of that portfolio is actually quite low. So Swensen was famous for looking beyond just stocks and bonds. And whilst lots has changed since the 1950s, now investors are not immune. So if you look at how the market has kind of evolved since the 1950s, the 60-40 asset allocation strategy still makes sense, but investors now have better tools available to them than Markowitz did back in 1950. And so first of all, if you think about bond markets, they've exploded. Corporates can issue bonds. The same bank can issue many different types of bonds with different coupon rates and varying degrees of risk. Governments around the world, including emerging markets, they can issue bonds in their own currency or in a hard currency, such as the US dollar. If you think about privatization, what that's done, so locally, CBA, Telstra, and many utilities and energy were government owned in the 1950s, and private companies didn't own roads, but they do today. Another underestimated event for investors was the end of the gold standard, with currencies no longer having to be backed by physical gold. You've also seen the rise of private markets, and since 2000, private markets have grown 5 times faster than public markets. And finally, what has been penned as the biggest challenge of our time is climate change. And so these are all elements that have changed the investment landscape and the way that investors can approach their own portfolio. Now, we've spoken about the Yale Fund and how it approaches diversification, but closer to home, the Future Fund is Australia's own sovereign wealth fund and our biggest institutional investor. And it too has taken a diversification approach beyond both bonds and equities. And in December last year, they actually published a very interesting paper called The Death of Traditional Portfolio Construction. And in this paper, they highlight that investors need to think beyond traditional approaches. And we argue that this would actually extend beyond institutional investors, and with ETFs allowing individual investors to take advantage of their own portfolio diversification. But within this paper penned by the Future Fund, they outline 7 key issues that investors need to consider. So if we look at what those 7 key issues are, first of all, it is that alpha is more important than ever. And so what alpha means is outperformance. And with tougher economic conditions and sticky inflation, the total return outlook isn't great from traditional indexes. So we need to seek something above and beyond that. Secondly, they look at more regional differentiation. And so this is about looking at individual countries in relation to their equity and bond markets and being more selective. they look at having more correlation caution. And so this was a big one, in 2021, as we looked at earlier, things that were correlated on the way up were correlated on the way down. And, fixed income, which is considered a defensive asset class, wasn't actually that defensive through that period. So, investors must be mindful of long-term correlations when building portfolios, as they may not hold true in this, difficult current environment with, inflation and higher rates. There's also a consideration for, the higher inflation and volatility. And with high inflation, we need to look for assets that provide a hedge against that risk. And commodities are one area that could play a bigger role in portfolios going forward. They recommend having a more dynamic approach as well. And so this is being able to pivot portfolios more when, those certain opportunities do arise. There's a focus on having foreign currency and being aware that it may actually not be that defensive. And so the US dollar is one example, which has been historically a more defensive exposure, but Australian investors must look via a currency lens and understand that, respective currencies can be a detractor or contributor to return. And then finally, there's consideration for decarbonisation and the energy transition. And so with this changing real asset landscape, investors should be aware of what will and won't be in demand going forward when they're making an investment decision. So in considering what this could mean for investors' portfolios, the Future Fund has taken a total portfolio approach with a strong emphasis on genuine diversification. And so in the paper, they highlight the newer levers across the portfolio that they're using to help it be more resilient in the current environment. And these include having more private equity, having a broader currency basket, a focus on liquidity and dynamic asset allocation, increasing their own infrastructure exposure, having detailed levers for developed markets and emerging markets, and adding to gold, commodities, tangibles, and alternatives. Now, as individual investors, ETFs allow ASX investors to access these levers for private equity, infrastructure, and gold without the need for large capital outlays and long lockup periods that are known to those asset classes. So via the ASX, ETFs such as VanEck Global Listed Private Equity ETF, GPEC, GPEQ, provides investors exposure to listed private equity companies. VanEck Global Infrastructure ETF, IFRA, provides you exposure to global listed infrastructure companies. And VanEck Physical Gold Bullion ETF, NUG, NUGG, gives you the exposure to physical gold bullion. And these are all tradable via the ASX. There's also, broader exposures on the ASX that provide investors, the tools to address those levers that the Future Fund highlighted in their paper, and those core factors or concerns that investors should consider. And so when looking at alpha being more important than ever, investors can use broad-based smart beta equity strategies such as the Australian Equal Weight ETF, MVW, or VanEck International Quality ETF to address that area within their core allocation. In terms of regional differentiation, VanEck China New Economy ETF provides exposure to China A shares, and VanEck Global, Emerging Market Bond ETF, EBND, provides exposure to emerging market bonds, so away from traditional developed market bonds. Considering correlation caution, China A shares, those emerging market bonds, and also carbon credits are some examples that fit into that kind of bucket. and having a more dynamic approach. Fixed income is something that you can consider there, and we'll touch on that a bit more shortly. But having a consideration for either fixed rate bonds or floating rate bonds based on your targeted outcome. And then finally, in terms of that decarbonisation and energy transition, there's levers on the ASX in terms of VanEck Global Clean Energy ETF, CLNE, and VanEck Global Carbon Credits ETF that can provide both the equities or the alternative exposure to that theme. Now, these areas that we've looked at are not the only areas that the Future Fund invests. And if you look at the way in which the Future Fund approaches Australian and international equities, they've made no secret to how they've been investing in the asset class in which traditionally active managers have traditionally underperformed. And in their 2018-2019 annual report, they stated that the Future Fund uses smart beta approaches in its quest for alpha. So, if we look at some options of smart beta available to you on the ASX, for broad-based international exposure, VanEck has the VanEck International Quality ETF, QUAL. And so what Qual does is it provides investors exposure to 300 international companies that have been selected on the basis of meeting the quality factor, in that they have a high return on equity, stable year-on-year earnings growth, and low financial leverage. In terms of addressing those Future Fund levers that they've highlighted, it's adding to that alpha being more important than ever. It's providing you regional differentiation away from the ASX and to international companies. And it's a more dynamic approach. You can trade in and out of it via the ASX as you please. VanEck also offers a hedged version of this fund, which removes the currency exposure under the code QHAL, but the underlying portfolios of both funds here are exactly the same. So if we look at how Qual has performed, it's historically achieved alpha, and what we're showing on the slide here is performance of Qual relative to the benchmark MSCI World X Australia Index since it's been running. And you can see that it's outperformed. Now, emerging market bonds are another asset class in which the Future Fund invests. And as Australian ASX investors, they can get exposure to emerging market bonds via VanEck's emerging market bond active ETF, EBND. This is addressing the levers of having that regional differentiation, being cautious of correlations, and being also a dynamic approach. This is an actively managed bond strategy by our portfolio management team in the US. And if we look at why you want to be exposed to emerging market bonds, well, they're actually a lot more fiscally sound compared to developed market bonds. And if we look back at what central banks were doing in emerging markets while developed market were hoping inflation was transitory, well, those emerging market central banks were actually hiking, so earlier and better than the developed markets. So they might be quite far ahead of where the developed market currently is now. So there could be quite a bit of opportunity for investors going forward. But given that there are certain intricacies within emerging market allocations, we think that a dynamic approach makes sense here. Hence why we've taken an active management approach via our active ETF. And if you look at how that's actually performed on the next slide here, you can see that versus its own benchmark and also against the standard Australian bond index and the global bond indexes, our VanEck emerging market bond active ETF has actually outperformed. So you've actually got a better return for both Australian bond indexes and global bond indexes since we've been running this strategy. Now, finally, if we come back to fixed income, remember that chart we looked at earlier in the presentation about the 2022 bond market return, where it was approximately negative 10%. Well, what if I told you that if you'd taken a more dynamic approach and to diversifying within the asset class to what's called floating rate bonds, such as FLOT and sub-D, they actually had positive returns during this current rate rising environment. And so this is really highlighting that having that lever for a more dynamic approach can be really optimal for investors in their portfolio construction journey. So at VanEck, as passive ETFs in the fixed income space, we offer both fixed rate and floating rate options. Those floating rate options are those two on the right-hand side of the slide, so FLOT and sub-D, SUBD. And we also have Plus, which provides fixed rate bond exposure as well. And so investors can dial up and dial down that exposure to fixed or floating based on what they're looking to harvest. And so if you look at what's actually happened currently and also during previous rate rising cycles where the market's anticipated rate rises, is that floating rate bonds have actually outperformed fixed rate bonds. So now if we come back to that efficient frontier that we looked at earlier as developed by Markowitz, we've actually done the maths in terms of what the new efficient frontier looks like. Obviously, we recommend that investors always first read the PDS and consider their own personal circumstances. But what we're showing on this chart here is that asset classes that are closer to the curve are better from a risk-return trade-off. And an optimal allocation along the line includes a combination of all these assets or asset classes that are charted. Something that's worth highlighting is that you can see that Australian listed property is quite far away from the curve. So from an optimal allocation perspective, it doesn't score too highly in that way. Whereas the likes of Australian equal weight, some corporate bonds, international quality are all pretty close to the line, which highlight that they represent a decent risk reward trade-off for investors. So, the 60-40 portfolio isn't dead, but we believe that it's changing and we believe for the better. And so, the rise of ETFs has created tools for investors of every type to create their own 60-40 diversified portfolio. And in terms of growth assets, the ASX includes opportunities across private equity, infrastructure, listed property, and smart beta. So thanks for listening. We're going to head into some questions shortly. So if you have any, please type them into the Q&A.
Thanks, Julian. All right, we'll get the questions started. All right, the first question for you, Julian, we've got, can you provide optimal bond strategy given current forecasts and conditions? What to avoid and what to look out for going forward? So when looking at fixed income options, so of course depends on person, but Julian, give us a go for that one.
Yeah, definitely depending on your own circumstances. But given that we've been in this kind of inflationary environment and as a result, interest rates have been moving higher, bonds have a negative, move negatively with interest rates. They have a negative correlation. So when interest rates are going up, the value of bonds goes down. Hence why you've seen that negative returns 2021, 2022, as we've seen rates moving up over that period. So what we have seen at VanEck in terms of the flow into our ETFs is that there's been a strong preference for floating rate exposures in the current period because they don't have that same duration risk or interest rate sensitivity. So for a lower risk exposure, investors can allocate to floating rate and not be, I guess, have as much worry around what the negative impact of interest rate rises is going to be on their portfolio. But at the same time, what we've shown is that given that rates have moved up quite substantially from the low point where the cash rate was 0.1%, is that now you've got a bit of buffer room. And so rates might move a little bit higher, but a lot of people in the markets at the moment see that we're kind of at the top of that interest rate cycle. And so if the rates then to come off, fixed rate bonds actually do well when interest rates come off. So it's about having an appropriate blend of fixed and floating rate within portfolios. They both provide or play different roles. Sorry.
Thanks, Julian. There's a few questions here around hedged versus unhedged options. So a mixture of those questions is qual versus QHAL, which is better now, pros and cons?
Yeah, so good question. So obviously, we're seeing the FX rate at the moment around 67 cents Aussie to one Aussie dollar is 67 cents US. And so long-term average for the US dollar exchange rate relative to AUD is kind of in the 70s. So some people would be saying that, more than likely over the long term might move a little bit higher. If the FX rate does move back into the 70s, taking a hedged approach is going to be more optimal, because you're not going to have the negative impact of the FX rate moving against you. Whereas being unhedged, if kind of the Australian dollar weakens against the US dollar further, then the unhedged investor will pick up a bit more. So it depends on your kind of risk tolerance. We can't, guide you in terms of where the exchange rate, FX rate is going to go. We don't know. But taking a hedged approach takes the, risk of FX movement out of it.
Thanks, Julian. We've got, please confirm gold ETF, I think they're talking about, so our one, NUGG, is not the same as physical gold in a safe. So how is gold? Yep.
So look, we last year we brought out a physical gold bullion ETF, NUG and NUGG, and what it does is it actually is physically backed by physical gold bars at the Perth Mint, and that gold is actually sourced only from Australian gold mines. So in a way, it is the same as physical gold. But it removes your own ability, or your own need to have to pay storage costs for that. You by owning units in NUG have an underlying entitlement to the gold that actually is stored and held. And if you wanted to, you could actually convert your units in the ETF and take physical delivery of the gold that kind of backs your units. So in a way, actually would say that it is the same, but it's held as an ETF, so you can see it in your portfolio. And if you wanted to, you can you could convert it and take delivery.
Thanks, Julian. We've got another question. We've got why qual and not moat or goat?
I don't think it's a not moat or goat. It's just in terms of our time constraints, we couldn't cover too many of our funds. But yeah, definitely moat and goat, which is some other international and US ETF options that VanEck offer, are other good smart beta alternatives that address some of those levers that the future fund is highlighting, like alpha being more important than ever. So yeah, definitely something else that's worth considering when you're building a portfolio.
And a quick one about qual. We've got how frequently is qual rebalanced or reviewed?
Yeah, so the index methodology is reset semi-annually. And so on the kind of 6 monthly, what is done is the top 300 best quality companies in terms of having that high return on equity, stable earnings growth, and low financial leverage will be included in the fund. So every 6 months, that's redone.
All right, our next question, we've got, all right, we'll do this one. We've got, can you explain carbon credits? So I think you touched on them, but we didn't go through them.
Yeah, so VanEck, we've got a global carbon credit ETF. XCO2 is the code on that one. And what that does is it provides investors exposure to the price of carbon. So what we're investing in is the futures contracts across the 4 key carbon exchanges globally. And the reason for that is that as an ETF structure, that is the most efficient way of getting exposure to the credits. Buying the credits themselves isn't really feasible. So by buying the futures, you've got exposure to that underlying price. And so what carbon credits are, essentially they're a tax on carbon emissions. There's two ways you can tax carbon emissions. You can do a carbon tax and tax total emissions that a company emits, or you can do an emissions trading scheme. And within an emissions trading scheme, you say you as company A can pollute so much into the atmosphere each year in terms of carbon emissions. Here's your quota and credits that you've got for that. If that company wants to pollute more or needs to pollute more, they'll then need to go into the market and buy spare carbon credits off other companies that aren't actually going to emit that much. So it creates this trading system where those that need credits can buy them from those that don't necessarily need them. And that is really how the price of carbon gets set. From an investor's perspective, why you'd want to be exposed to carbon credits, well, I guess it's the theme of that decarbonisation, the move away from fossil fuels and a greater focus on the environment. Also for investors, I guess providing a potential hedge against future carbon risk within portfolios, as companies, BHP is a good example. It's got operations in certain jurisdictions that need to be buying these credits for. Well, then they're going to have to buy more and more of these credits, which is particularly going to impact their underlying profitability. So if you've got exposure to the price of these credits yourself, that's going to provide some offset or hedge against carbon risk going forward.
Thanks, Julian, for that explanation. Our next question we've got, why is the range of management fees so high? Does lower fees mean less active management of the fund?
Yeah, so look, the management fee that we charge across VanEck ASX-listed ETFs, varies quite considerably based across, I guess, the asset class and the exposure and what the underlying strategy kind of is necessarily doing. So, for instance, some of our higher fees, so we looked before at China New Economy. Now, the China New Economy ETF is, I guess, tracks an index that's we're partnered with a quant research firm out of the US that provides this quantitative screening process, which is, I guess, one layer of the fee. But then also, trading costs in China are quite a bit higher. So as a result, that fund has a higher management fee than something like our Australian Equal Weight ETF, which has a management fee of 0.35%. Now, from VanEck's perspective, we're more focused on what's termed smart beta investing, as opposed to kind of market cap. And so smart beta is just anything from an index perspective that's not market cap or size weighted. So that can be like equally weighting, factor base weighting, ESG, and the like. And so from an index construction perspective, there's actually more, I guess, to the index than just taking that standard size weighted approach. And that size weighted approach is kind of what you see generally from like a Vanguard or iShares. And that's where you see kind of those lower fees, given that, or I guess very low fee, because it's much simpler as an index. Whereas smart beta is that real intersection between passive and active management. So as a result, the fee is kind of in between as well.
Thanks, Julian. Our next question, we've got two about the efficient frontier we presented. So I might quickly answer the first one about the time frame. So that was looking back over the last 20 years to May 2023. And then the next one for you, Julian, we've got, does ASX property only include commercial real estate?
So that what we were looking at there for ASX property, which was graphed on one of those last slides, is like AREITs, real estate investment trusts. So like your Charter Hall, your Centre Group, your Goodman Group, and the like as well. They fall under that ASX property that was graphed there.
Perfect. All right. We've got, regarding bond funds, are there risks that these will go down when companies need to refinance at higher rates?
Look, I'm not too sure how that question's to read that question, but look, as kind of rates move up, that has a impact on the underlying bond value kind of automatically. So bonds that were issued at an interest rate of say 4%, if rates move up 1%, well, the yield that bond that was 4% is actually then paying kind of a 5% yield because the capital values move down, which is what we've seen with rates coming off. So I guess, yes, companies will have to have higher funding costs on their own account, but it's not necessarily going to impact the bond values per se, because those new bonds will be issued at that higher interest rate.
Thanks, Julian. I think we've got time for one more question. We've got, is VanEck looking to establish a 60 portfolio of ETFs and a 40 portfolio of ETFs so investors and advisors can have simple access to these ideas?
Look, if you actually go onto our website, we actually break down across the different asset classes that we're investing in. So it's quite simple to kind of see what are those defensive asset classes, which traditionally the 40 or defensive would be kind of the bond component. And what we looked at on one of these slides this morning is you can see that we've got those fixed rate bonds, we've got floating rate bonds, we've got subordinated debt, and then we've got two active fixed income strategies as well. So one is that emerging market bonds, and one's a global hybrid strategy. So we've got 4 or 5 odd ETFs in the kind of defensive traditional component. What we're saying with this presentation today, though, is that areas like infrastructure could potentially be considered as a more defensive asset allocation in this new kind of world of investing, given how it's changed. And so if you then look at what other exposures we've got, most traditionally would fall under growth. But then you can kind of pick and choose other ones out of there that might be kind of more defensive, like your private equity, or I guess that's more of an alternatives exposure, but adding that in, so not just having a standard 60-40, stocks bonds.
Perfect. Thank you all for having such great questions. We'll leave the Q&A there. Thank you to everyone who joined us today, and thanks, Julian. Once you do leave the webinar, you'll be directed to a quick survey. We'd really like to hear how you found today, and if you have any further questions about what you've heard or about any of our funds, we definitely want to hear from you. Hope you all have a fantastic rest of your Thursday, and we'll see you in our next webinar.